A fund manager friend of mine suggested that the best approach would be for people to put their savings in a low-cost index fund and then give the money saved in fund manager fees away to a worthy cause. Impact investment is an investment strategy which explicitly combines the objectives of financial returns as well as social good. The International Finance Corporation defines impact investing as investments made into companies or organizations with the intent to contribute to measurable positive social and environmental impact alongside financial returns. So what an impact investor does is to add a second objective to achieve positive impact on targeted social, governance, or environmental goals. This requires integrating impact considerations alongside financial considerations into the portfolio's investment strategy, into decisions about whether to buy and sell assets, and into the information and data that investors monitor and manage. This raises two fundamental questions, which are firstly, whether there is invariably a trade-off between financial returns and social outcomes, and secondly, how easy it is to measure the social outcomes which have been targeted by the investment strategy. Having a clear answer to these two questions is essential for the impact investment asset class to establish itself. Impact investing is part of socially responsible investing, but represents the part of it which gives the most importance to social factors, because these are now an explicit investment objective, unlike in other forms of socially responsible investing. We could think of it as a progression from for-profit only investing to compliance-driven investment which excludes certain types of assets, to investing with good ESG processes in place, and finally to impact investment where social good counts as much as financial returns. Let's go straight to a simple example and return to Fred's ice cream stand, which was mentioned in a previous module on ESG. Fred believes in treating his assistant Lorena well, so pays her better than average, and also gives her a training allowance. He also only sells homemade bio ice cream with no extra sugars or additives, which helps with making local kids less obese. Using an ESG approach in which we quantify externalities, we assign a euro value to the social benefits of Lorena's extra salary, her training allowance, and the saving in local kids' health costs. Fred's main focus is on running his business, which he does ethically. Now let's look at Fred's ice cream stand from an impact perspective. We have the dual objective of earning a financial return on the business, combined with an objective of giving better lives to employees and improving the health of local kids. Applying this approach, we can see that our metrics now change from a financial measure, which was the ERR of the previous module, to metrics which are now the number of employees with better lives and the number of local kids who are less obese. These are social metrics and no longer financial metrics. And this is the essence of impact investing. Let's look at the history and the developments of impact investment asset class, which, as we shall see, intersects with parts of the private equity asset class. In some form, impact investment has been around for a long time. We can give the example of the 17th century when English Quakers would invest based upon their religious values. More recently, we can point to US charitable foundations and community development institutions, microfinance in emerging markets, and the general development of the philosophy of socially responsible investing, all of which started to develop in the 70s. The main impetus for the development of impact investing as an asset class came from a combination of charitable foundations, developmental finance institutions, and some pioneering impact fund managers. The most prominent of these are the Global Impact Investment Network, GIIN, an offshoot of the Rockefeller Foundation, and the International Finance Corporation, as well as centers of knowledge such as Heidelberg University in Germany. The IFC published its operating principles for impact investment in 2019, which take into account the Sustainable Development Goals of the United Nations Development Programme. GIIN has developed an impact measurement system, IRIS, whose objective is to set standards for the measurement of social outcomes. There are a number of other protocols and initiatives globally, and these are all in evolution, reflecting the relative youth of the aspiring impact asset class. Part of the forces driving the development of impact investing include a desire for new approaches by philanthropists, a new generation of social entrepreneurs launching ventures with both a social and business objective, government seeking to partner up with the private sector due to budget constraints, and the rise of online social networking platforms which provide the opportunity for people to decide directly which good cause to contribute to. The types of investors engaging in supporting impact investment include wealthy individuals, family offices, foundations, development financial institutions, and on a more ad hoc basis, banks, pension funds, and insurance companies. Pension funds and insurance companies are more constrained by their fiduciary duty to maximize returns for their policyholders. The sectors which attract impact investment are typically those concerned with basic needs, such as agriculture, water, energy and housing, and basic services, such as education, health, and access to finance. A big portion of impact investments are made in emerging countries, such as in Asia or Africa. It can sometimes be more difficult to develop visibility of a relevant social issue or group in more developed markets. One of the selling points of impact investment to the not-for-profit sector is the concept that the capital deployed will be returned and can thus be redeployed again. This can alleviate the issue of having to secure donor funding each budget year, with the risk that a program may terminate because the funding becomes available in a particular year due to a change at the donor level. We compare this to the selling point of impact investing to commercial investors, which is that they can do social good while at the same time earning an appropriate return on their capital. Let's turn now to what concerns us the most, which is, what is the intersection between impact investment and private equity? Impact investment is not a new sub-asset class of private equity, but rather we can say that a number of private equity funds are describing themselves as impact funds. Many of these funds offer debt products only, so there can be a question mark as to what extent they are really private equity funds. It is in the area of mid-cap private equity that we see the most funds that incorporate a social impact into their investment strategy, and for the majority in emerging market countries. This is not surprising because most lower mid-cap funds operated in emerging markets will have a positive social impact even without it being an explicit objective, simply by virtue of the ESG upgrades they will incorporate into their portfolio companies. As of today, dedicated impact funds still represent a small minority of total private equity investors. Of the about 7,000 GPs active worldwide, perhaps a few dozen can be considered dedicated standalone impact investors, with others being more mainstream GPs who are adding impact to their overall portfolio. Examples of the first kind are Bamboo Capital Partners or Leapfrog Investments. Examples of the second kind are TPG, Bain Capital and KKR. The open questions in impact investment are firstly, how can we measure social returns? And secondly, is it possible to achieve economic financial returns without any trade-offs? For the first question, we turn to several efforts made in the field to develop standards of social measurement, such as the IRIS system developed by GIIN, as well as other comparable initiatives in Europe like Heidelberg University and others. What we need is that when two impact funds say they have increased literacy among a group of African children, for example, that they mean the same thing. This is much harder to measure than a financial return. There can be no doubt about that. For the second question, the evidence is not yet conclusive, also because impact in private equity still does not have enough of a track record for firm conclusions to be drawn. Early evidence points towards some difficulty in not having trade-offs between these two objectives. Some major developmental institutions still have a target annual return for the impact GPs they back, which is lower than the target for the commercial GPs, typically by 5 to 8%. Another debated question in impact and funds in private equity concerns the profile of the fund manager. People will either study economics and finance and go into private equity, or study public policy and development and go to work in the public sector or for an NGO. A hybrid professional is probably still a risky career move for most, with the risk of falling in between the cracks. Many people involved in impact have been a mix of early-stage pioneers or second career giver-backers and a few others. We still cannot speak about a depth of qualified people to fill the whole sector. Let's conclude by looking at where impact investing is today. A fund manager friend of mine suggested that the best approach would be for people to put their savings in a low-cost index fund and then give the money saved in fund manager fees away to a worthy cause, thus subsidizing the lifestyle of intermediaries, including impact fund managers. It is true that in many cases, what started as worthy impact investment ended up straying away, as we saw when microfinance ended up making some investors rich via IPOs. The best way to look at impact investment for now might be as an approach, a methodology, which can be implemented in different contexts, rather than as a distinct asset class.